All right, good morning or afternoon, everybody. We will get started in just a few minutes. We'll let everybody start to trickle in here before we get started. So give it a minute or two, and we'll get started here in just a short minute or two. Okay, hopefully everybody can see me. I know that music was catchy, but it's time to get on with the business at hand. Welcome to today's webinar on what am I investing in, using data to evaluate an investment. So today we will be focusing on turning the numbers into knowledge. And just as a precursor, we are going to be getting into a lot of different numbers and metrics and whatnot. So if that's not your thing, just be forewarned. I'm not going to ask you to do a whole lot of math, but we are going to be talking about a number of different metrics and number related things as it relates to an investment. I will do my best to keep it high level and make common sense as much as possible. But just keep in mind that we are talking about data today, so we're going to get a little wonky for those that are number nerds. You should enjoy this, okay? All right, hopefully everybody can see my slide. Should be the title slide to the presentation. If you have any technical difficulties, you can't hear me, see me, or you're not seeing what you think that I might be referring to, just let me know. Sherry and Taryn and Nicole, I think, are going to be monitoring as well, just to make sure that there's no technical difficulties. Okay, so we got a lot of material to go through today. The plan is to go through the conceptual stuff, and then at the end, if you have more questions that you want me to address, or you want me to show you some live examples using real world investments, I'm happy to utilize some of my technology tools to dig into the details a little bit more. Okay, all right, so that's where we're going. So why does this matter? All right, well, investing without understanding the fundamentals is kind of like sailing a ship without a compass, or driving a car without a speedometer. You need the gauges, you need the metrics to know how you are driving this vessel, okay? And just like the ocean has lots of choppy waves, markets are noisy, emotional, and full of hype. We've all seen things on the news. When we see the market reports, some of us, not everybody, but some of us see the market reports on a daily basis. And, it can be confusing, overwhelming, and, frustrating a lot of times if you don't know what you're looking at. Okay. So data gives you the clarity, the confidence, and the control over your investment decisions, so that you can kind of put away the hype and just focus on what matters the most. So today, I'm going to go over kind of a practical framework for evaluating stocks, mutual funds, ETFs, bonds, just general investments in general. A lot of these concepts are going to be sort of applicable across a number of different types of investments, but there are certain investment types where some numbers, some metrics mean more than others. And we'll dig into that. All right. So, what are we going to cover today? We're going to talk about the problem. We're going to talk about metrics to know for individual companies and for mutual funds and ETFs. This will also somewhat apply to bonds and fixed income as well. And I think you'll see why as we get through it. We're going to talk about interpreting financial statements, tools for analyzing risk and return, separating facts from hype, and we'll end with giving you an investment evaluation checklist and take some questions and answers like I mentioned. Okay. Now, as always, if we get through this and you're just like, wow, that was a lot of information, I don't remember it all, I couldn't take quick enough notes, rest assured this video will be recorded and posted to our website for you to go back and review, watch and review in the future. If you want to see a little bit more about something that may have gone a little bit over your head. So rest assured that it's going to be available for you. But as always, you can call or email us, and I'm happy to walk you through in more detail some of the nuances of what we're going to be talking about. All right. So the modern investor's challenge, right? So we are inundated on a daily basis from information on our TV screens, on our phones. Not too many people read the newspaper anymore, but for those that do, if you open up the stock section, it's pages and pages of stock prices where you can get that online. There is rampant conflicting opinions about whether or not an investment is good or bad, is it expensive, it's cheap, where it's going, right? And oftentimes that leads to emotional decision making. And if you didn't attend my webinar last month where we talked about the psychological aspects of investing, you might want to go back and take a look at that, because I was reviewing the various biases that humans encounter when making investment decisions. So we've all experienced the friend or uncle's hot tip about what they're investing in. We see influencer hype. We see marketing materials. We're constantly being bombarded by commercials and other things that indicate buy this or buy that, providing high returns. But we're not necessarily always talking about the risks associated. So when we get through the data, it basically helps us to cut through the noise of some of these things and allow you to make your own, hopefully informed decision about whether or not to invest in something. Okay. All right, so let's start with it. Metrics for individual companies. So we are primarily talking about publicly traded companies on one of the major stock markets. So the Dow Jones, the S&P 500. The Dow Jones, the S&P 500, the Nasdaq, any of the individual companies that you may think of on a day-to-day basis that might come to your mind, whether that's Starbucks or Tesla or Walmart or Target or you name it. There's all sorts of publicly traded companies out there, and at times you may be interested in investing in those individual companies, putting your money in place as an owner so that you hopefully can potentially benefit from if that company is run well. So how do you know whether or not making an investment in an individual company makes sense? Okay. So what you see on the screen here are some of the primary metrics that you're going to want to review or have a sense of when you are evaluating an individual company stock. So the first and foremost is profitability, all right? So profitability shows the business's overall strength, okay? It is how much money is that company making for what it does in terms of selling its products or services. So here are some of the key elements of profitability: revenue growth, a gross operating or net margins. So revenue growth, that is basically the top line, right? How much the company sells its products or services for what it does, right? So the revenue growth is a measure of how quickly a company is increasing its sales over time. And clearly, strong, consistent revenue growth is going to suggest that the business is expanding its customer base and selling more to clients. Okay, so let's talk about these margins. Folks that aren't necessarily as familiar with business operations may or may not be familiar with the different types of margins. So the first one on here is gross margin. Okay, margin basically means profit. Okay, for every dollar sales, how much are you keeping? Okay, so gross margin shows how much profit the company keeps after covering its direct costs of producing its goods and services. Okay, so that is primarily sales minus cost of goods sold. So what would cost of goods sold be? So cost of goods sold is all of the raw materials that are used to make a product. So if you think about a car, you got a lot of steel, you got a lot of parts, all those things that let's say Ford Motor Companies or GM buys to make a car. Those are its cost of goods sold. Okay, so gross margin is sales minus cost of goods. Okay, hopefully a company has some margin after those costs. Higher margins often indicate higher pricing power, okay, or efficient production. Low margins mean that they have a lot of potential competition. Okay, so the next is operating margin, all right, and that reflects how much profit a company makes from its core operations before all of the other expenses such as interest and taxes. Okay, it is an indicator of how well the company is being managed. Okay, and then obviously net margin is how much the company, or the shareholder, I should say, gets to keep after all of the entire expenses of the business are paid for. Okay, so gross margin, operating margin, and net margin. The next on our list are the valuation metrics. Okay, so the valuation metrics effectively show you what it is that you're paying for. I would say probably the primary and most popular valuation metric is the price to earnings ratio. Okay, so price to earnings, what exactly is? So that is the price of the stock that it's trading on a given day or time, okay, divided by its earnings, its reported earnings per share. So of that net margin, okay, that net margin is the earnings. That's the E in the PE ratio. So that total net margin is divided by all of the shareholders, and that is the earnings per share. And your price to earnings ratio is the price of the stock divided by their earnings per share. The PE, what does it tell us? It tells us, it compares the stock price's earnings, okay, relative to, it allows you to compare the relative cost, whether it's expensive or cheap, for each dollar of earnings. So let's say hypothetically, all right, the share price of a stock is $100, okay, and its PE ratio is 10, okay. So you're effectively buying, what you're doing is you're paying, the PE ratio of 10 means you're paying $10 for every dollar of earnings that the company is producing. Okay, so a high PE can signal that the company is expensive for the amount of earnings that you're paying for. A low PE could mean that the company is discounted. Okay, a high PE could signal strong growth expectations or penetrations into new markets or launching new products. A low PE may signal that the market, the public, the investing public doesn't think much of that particular company for various reasons. Okay, so the PE ratio. The PS, price to sales, is similar. It compares the stock price to the company's revenue. All right, and this metric is more useful for companies that have little or no reported profit. So you can kind of think about companies that might be in a startup phase. They don't have any reported profit, or maybe they have negative profit because they're making large investments to grow the company quickly. You're going to refer to the price to sales ratio in those circumstances rather than the PE ratio. Okay. I'm not going to talk about the EV versus EBITDA. That is a metric, but it's not one that is probably as applicable for this presentation. So let's move on to the efficiency ratios. Okay. So the efficiency ratios effectively show how well the management of the company is delivering to the shareholders of that company. Okay, and the two primary ones here, and there's many others, but the primary one is the return on equity. Okay, return on equity measures how effectively a company uses shareholder money to generate the profit. So you invest your money, you buy those shares into the company, okay, and then your expectation is that you're going to get a return on that money. That return is going to come in the form of either revenue, distributed dividends, or it's going to come in the form of an appreciated share price. So generally speaking, when we're talking about annualized returns or those types of things, we're primarily talking about return on equity. The next one is the return on assets. Okay, so similarly to the equity component, how much I as a shareholder own, the company itself has an asset base. You can think about that as property, plant, and equipment. That might be vehicles or buildings or all of the other stuff that they use to make their products. They have an asset base. So your return on assets shows how efficiently the company is using those total assets to produce its earnings. Okay, and this type of metric is especially applicable to businesses and industries that are heavily asset intense. Okay, like manufacturing, particularly where there's lots of capital equipment used to make the products. Return on assets is important. So, for example, if you have a lot of assets that are sitting idle, then that metric is going to be relatively low. Versus if you have all of your assets actively producing and generating products and revenue, then that metric is going to be high relative to its peers. Okay. All right. Other metrics, operating cash flow. So if you've heard that term cash is king, that really is the key here. So we're going to talk about the financial statements for businesses here in a little bit, but cash flow is the lifeblood of a business. If a business does not have cash flow, the business does not exist. Okay, so the first on here, the cash flow shows the real financial health of a business. Okay, if it sells a lot of products and services, but it can't collect on its what it sells, then the company will die. So the operating cash flow is showing how much cash the company generates from its core business activities. Okay, so a strong operating cash flow means that you have a good, solid, sustainable business. Okay, there are other ways to raise cash, right? There are investing activities. You can go ask investors to give you money. All right, you can raise debt. Okay, those do not fall under the operating cash flow. right? The operating cash flow is cash that's generated from the company doing business. Okay. Now the next one on here is the free cash flow. So free cash flow is the cash that's left over after the company pays for all of its operating expenses, its capital investments, the interest on its debt, its dividends. Basically, it is the money that's left in the bank after the company clears its books for the month. Okay. Now, one other thing on here with respect to cash flow, and that is the cash conversion cycle. Like I said, cash is king. It is the lifeblood of a company. If a company cannot collect on its cash, it will wither and die. So the cash conversion cycle is, and it's not on here as a bullet point, but it's something that I'm going to leave you with. Cash conversion cycle is how long does it take for the company to collect once it's sold its products or services. So if you look at, say, for example, Amazon, where they're collecting the cash before that product is even shipping from the warehouse, that's a pretty quick turnaround. It's actually like a negative cash conversion cycle, versus if you have a situation where a contractor has to build a house before he gets paid. Well, that wouldn't be so great a cash conversion cycle. So every business has different cash conversion cycles. The important thing is to see how that cash is being collected relative to its peers, and does it have enough cash to function as a business. Okay, so these are the numbers behind individual companies, and these are the ones that tell the story. Okay. All right, so let's talk about mutual funds and ETFs, right? So mutual funds and ETFs, these are groupings of individual companies, right? So we talk about diversification. Mutual funds and ETFs are groupings, large groupings of individual companies or other types of investments. And so while what we just referred does apply to mutual funds and ETFs, it's a little bit less because some of those things are more watered down. Okay, so when we're talking about mutual funds and ETFs, we're kind of taking a step back and looking at it a little bit more broadly. Okay, so some of the categories of things that we're going to look at when evaluating a mutual fund or ETF or any type of diversified fund are these things behind their strategy, their cost structure, their composition, and their performance and risk metrics. So if we talk about fund strategy, right? So index versus active. Okay, and what does that mean? All right. Index funds are generally they follow a simple strategy. They aim to match the performance of a specific market index. Think like the S&P 500 or the Russell 2000 or something like that. The index funds are not trying to beat the market. They're trying to be the market. Okay. They don't require active management because all they do is they match the lineup of investments on the index. Okay. They usually have fairly low fees, low turnover, and pretty predictable behavior, at least as predictable as the market index would be. So when you're buying an index fund, you're essentially buying the broad exposure to the market at a low cost. So let's talk about that versus active funds. So active funds are taking the opposite approach. Instead of tracking an index, they are taking the approach of a manager or their team are selecting the investments that they believe will be able to outperform the market or whatever benchmark they're comparing themselves to. The potential upside is higher returns, but the trade-off is that it often costs more. There are generally higher turnover. When I talk about turnover, I'm talking about the buying and selling of securities, of stocks and bonds inside the fund. And there's the risk the manager underperforms their peer group or the market index in general. Okay, so when evaluating an active fund, it's important to look at the long-term performance of that active manager or this team, because you want to see are the costs that you are paying for that active management providing you the return that you should be expecting. Okay, And there's a long-standing debate about whether or not that is true or not. So I won't get into that. Okay, growth versus value. So what? Oftentimes we talk about what is the difference between a growth fund and a value fund. Well, a growth fund primarily focuses on companies that are expected to grow faster than the overall market. Okay, so historically these have been in technology, biotech, other types of innovative sectors where there is rapid growth. Okay, these funds tend to hold companies that have higher valuations, so higher PE ratios, and lower dividends. And oftentimes, these growth funds they're paying zero dividends, or they're buying companies that pay zero dividends. So they are primarily delivering stronger returns in good markets, but they also may be more volatile in downturns. Okay, value funds invest in companies that are considered in the value category. What is a company in a value category? Well, it is one that has solid fundamentals based upon the slide that we just reviewed. So value funds invest in companies that have strong cash flow. All right. They have strong book value. They have a strong asset base. They have predictable earnings, right? But they may not necessarily be growing real rapidly, right? They are good, solid. These funds are investing in good, solid, strong businesses, but they may not be necessarily the superstars that we see on the news on a daily basis. So in this case, think construction companies, utilities, so Caterpillar, PG&E. Well, PG&E may not necessarily be a popular one right now, but it is a utility company. So companies that are selling, cosmetics or things that consumers use on a regular basis. Those would be falling into the value fund category. All right, domestic versus international. So domestic obviously refers to primarily United States-based companies versus international would be, broad-based international. There's a distinction between large international and what would be considered emerging markets. So large international companies primarily going to fall in Europe or other developed countries such as Japan, and a few others. Emerging markets are going to be more of those growth areas such as South America, Africa, parts of Asia. So those are going to be domestic versus international funds. Okay, broad market versus thematic. So broad market is, again, broad brush. You're just going for the large basket, versus thematic might be something that is specific to a theme or an area. So it might be country specific. It might be sector specific. Think maybe an energy related fund or a biotech related fund. Those are thematic types of investments. Okay. And then lastly, bond versus equity versus mixed allocation. So an equity fund obviously is investing in equities. Okay, equities meaning company stock. Bonds or bond funds are primarily investing in bonds. Those are bonds that might be issued by governments, like the U.S. government or state governments. They also might be investing in bonds that are issued by companies. So rather than buying up the stock, maybe these funds will be buying the actual debt of a company instead of its equity. Okay. And then mixed allocation, that is diversifying between stocks and bonds. These might be things that are considered balanced funds, or they have a target risk allocation, such as a moderate allocation fund, that type of thing. Okay, so that's fund strategy. Okay, now we're going to talk about the cost and structure of the fund, things that you need to know about related to the cost and structure of the fund. So the first is, and then probably the one that's most attended to, is the expense ratio. So the expense ratio is essentially the annual fee that a fund charges to invest your money for you. Okay, so that's the annual cost that that you're paying, primarily from money. The expense ratio is when the individual investments in a fund are distributing income, such as dividends or otherwise. The fund managers are taking some of that to pay their own expenses. Okay, they're not doing it for free, so it's basically money that's taken directly out of your return. So you might think about if the gross return is 10%, but the expense ratio is 1%, then your actual return on investment is really 9%. Okay. Index funds are going to tend to have a very small expense ratio because there's not a whole lot of management that is involved. Actively managed funds are going to have a higher expense ratio. So an index fund might have an expense ratio in 0.1%, versus an actively managed fund might have an expense ratio of 1 or maybe even 2%, depending upon their strategy. Okay, so expenses, they matter. So keeping an eye on that is important. Also related to mutual funds and ETFs is the turnover ratio. So that is, again, how frequently the fund is being traded. So if you think about a 10% turnover ratio, a 10% turnover ratio would suggest that about 10% of the 10% of the fund's investments are being sold and repurchased. New investments are being purchased inside it on an annual basis, right? 50% turnover ratio, half of the investments are being sold each year. Very high, very high. So that has implications for the tax consequences of that particular holding. So that's why turnover ratio is important to be aware of. All right, so let's move towards the portfolio composition. Okay, so portfolio composition, we're going to include the top holdings, right? That looking at the top holdings of a fund is going to tell you what is really driving the performance. Even heavily diversified funds can be heavily influenced by a handful of large positions. And I think this is especially true right now. There's been a lot of media attention paid towards the Magnificent Seven that are composing a high percentage of the S&P 500 returns right now. So, or have been for like the last year or two. So top holdings is important. Sector allocation, right? So how much of the fund is invested to different areas, such as technology or healthcare or financials or construction, right? So this helps you to understand where your risk is concentrated and whether or not you are unintentionally overweighting yourself in certain parts of the market. Talked about U.S. versus international, so geographic exposure, how much of your portfolio is focused on U.S. versus Europe versus Asia versus the rest of the world, right? So what's happening in the globe may be influencing the return profile of your specific investment fund. Market cap focus. So market cap refers to how large a company is, okay? Market cap, oftentimes we are talking about funds that are a large cap fund or a mid cap fund or a small cap fund. And you can think about the companies that they're investing in relative to that. So large cap funds are going to be the largest companies in the country or the world, right? Small or mid caps are going to be smaller. But these are still publicly traded companies, and oftentimes they still have fairly substantial revenues in the tens to hundreds of millions of dollars per year, but they're not nearly the size of some of the large ones that we see on the news on a daily basis. Okay, large cap companies tend to be more stable, whereas small caps, while they can offer significant growth possibility, they also tend to be more volatile because they're more subject to, they're smaller. They're just smaller and, more vulnerable, if you will. Okay, so now we're going to talk about performance and risk metrics. So the first one, is your return versus your benchmark. Okay, oftentimes we see people comparing their portfolio returns against the S&P 500 or the Dow Jones or the NASDAQ. Okay, what I want you to think about though is your investment allocation invested the same way? So you got to make sure that you are benchmarking the thing that you're comparing against is similar to your investment. So if the only thing that I'm invested in is the S&P 500, then yes, it's reasonable for me to compare my portfolio against the S&P 500 and whether or not I'm doing better or worse than that benchmark. But if my portfolio is different, then you have to make sure that you're measuring it against the right benchmark. And sometimes we create blended benchmarks for portfolios to have an appropriate measure against. Standard deviation. Okay, standard deviation is the primary measure for how it is the primary measurement for how we determine how volatile a fund's returns are. Okay, so if I say if the company or the fund made 10% this year and 5% last year and 20% the year before and then lost 10% the year before that, then our returns are all over the place. The amount of money that company or fund is making is volatile. It's up and down, right? So that volatility is measured by standard deviation. The larger the standard deviation, the larger the swings in your returns, right? Generally speaking, investors tend to like low volatility and high predictability because that way they can make plans for what their income is going to look like, and they can make decisions. But if the returns and the money that they're making are highly volatile, it makes it more difficult to make plans for the future. That's for both individuals as well as business owners. All right, beta is another common metric that we use, and beta shows how sensitive a fund is to the market movements. So a beta of 1, okay, would mean that a specific investment is moving exactly similarly to the broader market or the thing that you're measuring against. So if I'm comparing against the S&P 500 and my investment has a beta of 1, that means that my investments move up and down the same way the S&P 500 does. A beta of 2 is going to mean that my investment is more volatile than that particular metric, versus a beta of 0.5 or beta runs from 0 to whatever. It doesn't go negative. So a beta of 0.5 or 0.25 would mean that it's a very low volatility type of an investment relative to the benchmark. Okay. Last on this list is the Sharpe ratio. The Sharpe ratio effectively tells you how much return you are getting for your risk. So this is similar to your PE ratio. So your PE ratio tells you how many dollars you're paying for each dollar of earnings. The Sharpe ratio tells you how much return you're getting, right? How much you're getting for how much risk you are taking, right? So a high Sharpe ratio means that you're getting a lot of money for a little bit of risk. A low Sharpe ratio means that you're getting little to no money, no return for a lot of risk, relatively speaking. So Sharpe ratio and beta are good metrics for comparing particularly mutual funds and ETFs against their benchmarks. Okay, I know that was a lot for mutual funds and ETFs, so let's move on to the key 3 financial statements. And again, this is primarily applicable to individual stocks, but it can apply to funds as well. Okay, so the key three financial statements when we're evaluating a stock, or for that matter, a bond, is the income statement, the balance sheet, and the cash flow statement. So the income statement is how much did the company make? All right. The balance sheet shows what does the company own and owe. And the cash flow statement, again, shows how much real cash is coming in and out of the business. And so the purpose of knowing these is understanding the business behind the stock, right? So the companies inside your investments. Publicly traded companies are required to publish these statements on a quarterly basis and an annual basis. So if you can go to any publicly traded company and it will have an investor relations site, and you can download the 10Q or the 10K. 10K is the annual statement and the 10Q is the quarterlies. You can download those and see exactly what is being reported to the investing public. Okay, and that is mandated by federal law for any publicly traded company, and it is administered by the Securities and Exchange Commission. Okay, so the income statement again, shows the company's revenue, expenses, and profit over a period of time. So income statement is going to have a start and an end. Generally, it's going to be the calendar year, January 1st to December 31st, or you're going to have a fiscal year where the company's income starts and ends sometime in between the calendar year. But either way, it's going to be generally a 12-month period. The balance sheet, again, provides a snapshot in time as of a specific date of what the company's financial position is at that time. It's going to show assets, right? Liabilities. So liabilities are debts or things that the company owes or has yet to pay. And shareholder equity. So the magic formula on the balance sheet is total assets minus liabilities equals shareholder equity. So if assets grow and liabilities sink, that means the shareholder equity increases. That means your ownership stake in that company becomes more valuable. And this basically allows you to see the financial strength of a company over time. And how it's is it taking on a lot of debt or is it paying off a lot of debt, right? Is the value of its brands or what it's making or its property, plant, and equipment, is that growing or is it shrinking? So balance sheet. Cash flow statement. So again, the cash flow statement shows the actual movement of cash throughout the business and is generally going to be broken into three different sections of operating cash flow, investing cash flow, and financing activities. Okay, so that's the key three financial statements. So what do we really want to look for when we're evaluating a company? And you can probably start to deduct your own conclusions about, as you're looking at individual investments, what is going to be positive and what's going to be negative, right? So on the income statement, we're going to be looking for overall profitability over time, right? Does the company have revenue growth? Does it have margin growth, right? Are there any big one-time items, all right? Any write-offs, any lawsuits, any downgrades or those types of things. So what we're really looking for in the income statement is consistency in growth, right? Is the business bringing in revenue? Is it growing profits? And is it doing that on a consistent basis? On the balance sheet, again, we're going to be looking at the overall financial health of the company. We're going to be looking at the assets, right? Are the assets growing? What are the debt levels of the company, right? Are those rising or falling? Debt is not necessarily always a bad thing, but so if a company takes on debt in order to grow revenue and grow profits and does that successfully, that's a good thing. If they take on debt and they don't do that, then that would be a bad thing. Okay. On the balance sheet, you're going to get the metrics that show the liquidity ratios. So how much cash on hand does the company have to pay its bills? You're going to look at the asset quality, right? Are these appreciating or depreciating assets? And leveraging trends, as we just talked about, how much debt they have over time. And then cash flow, again, just real cash movement. So we're looking for positive operating cash flow. That means that the business has sufficient cash to run and pay its bills. It's got sufficient free cash flow that is hopefully either being reinvested into new business projects or being distributed to the shareholders in the form of dividends. A red flag would be if you have rising earnings but falling cash flow. So that would suggest maybe there is some manipulation happening in the financial statements because cash flow is really harder to manipulate. It is, customer writes you a check, you deposit it into the bank, you turn around, you pay your bills, right? And what's left over is the free cash flow. So that's harder to manipulate than the earnings, which has some adjustments that can take place. All right, so with that, let's move on to next one. All right, let's talk a little bit about risk. Okay, so there's various risks associated with investing. For stocks, you're going to have market risk, business risk, debt risk, and volatility. And for funds, you're going to have diversification risk, sector concentration, tracking error, or manager risk. So let's just talk about these in order. So market risk, that is the risk that the overall market declines and pulls your investment down with it. So even if the company or the fund itself is performing well, this is the fact that, if you're on the Titanic and the Titanic's going down, you're going to go down with it, right? Now, maybe you're able to get yourself into a lifeboat, but generally speaking, the boat's going down. So that is market risk. So this is the risk of being associated with, say, for example, the S&P 500. If the S&P 500 goes down, and you have an investment in the S&P 500, then you're going to go down with it, relative. Then you have business risk. Okay, so that is the risk that an individual company has for being in business for itself, right? It reflects that risk, this business risk reflects the specific challenges that a company's operations might have. So things like competition or consumer changing preferences or supply chain issues or poor management decisions. Okay, so even in a strong market, companies with a high business risk can struggle. Good example is, Boeing was as an manufacturer of airplanes was doing really well for a long time until they inadvertently had a couple of planes crash, and then the company's stock struggled for a while because there was an aversion to riding on Boeing airplanes. That is a business-specific risk. Okay. Debt risk, that is for individual companies as well, right? So that is the risk that the company has taken on too much leverage, right? If they take on debt to maybe make an acquisition, and that acquisition doesn't pan out the way that they thought, then the company could be on the hook for that debt without the corresponding revenue or profits. And so that is the debt risk that a company might have. Oops, I'm sorry. I absolutely accidentally jumped a slide. Let me go back to it. Apologize. Oh, there we go. All right, and then we have volatility. All right, we talked about volatility a little bit. Again, that's the risk that your investment is going to go up and down, and so stocks with lower volatility are, all things equal, are going to be preferable. On the fund side, we're going to have diversification risk, right? So if you have a low amount of diversification, then you're putting more of your eggs in one basket. So the more diversification you have, generally speaking, the less volatility and the less risky your investment would be. Sector concentration. This is if you are overly concentrated in one sector or more. Key concern right now is there's an excessive amount of concentration in the Magnificent Seven or high-tech related stocks. So sector concentration can suggest that if that sector has a bad quarter or year or period of time, then your return might be lower as a result of being exposed to that particular sector. Tracking error, which is primarily for index funds, okay, is the risk that your investment, your fund, doesn't meet the same performance metrics as the overall index. So, let's say for example, an S&P 500 fund, it may have the same investments in approximately the same proportions as the actual S&P 500 index. But from time to time, that index is going to change, okay? And that's going to require the manager to make corresponding changes. Those changes may not happen at the same time. So there is differences, there's tracking error that occurs, and that this tracking error metrics indicates how closely that index fund is the returns are tracking to the actual index it's measuring against. And then lastly is the manager risk. So that is how well the manager is performing, how much the returns are performing relative to the benchmark that they're measuring against. So a manager charged with investing in, let's say, a Brazilian ETF, do they have to have a specific metric that they're measuring themselves against? And that manager risk is, are they exceeding or not against that particular metric? All right. So a couple of different risk measurements for funds and for individual stocks. For return, so we'll talk about return here. Okay. Stocks, you've got your total return. Total return is the amount of money that particular investment, that particular stock is providing to you. So 5% return, year-over-year return, 10% year-over-year return, right? That is how much growth that investment is providing to you, okay? It's going to come in the form of both appreciation as well as potentially dividends that are paid out. CAGR, which stands for compound annual growth rate. So that is how much your investment is compounding in its growth year over year. How do you see this? So oftentimes you'll see the CAGR rates reported in the 3-year return or the 5-year or the 10-year return. So that says that over the last 10 years, this investment grew on an average annual rate of, say, 10%. Okay, that's the average yearly growth rate of an investment. And then lastly, for stocks, you've got the dividend yield. How much of the earnings are being paid out? So if we have a 10% earnings and a 2% dividend yield, basically 2% of the company's returns is being paid out as a dividend, as a check to the shareholders. All right, we talked about return versus benchmark a couple of different ways. We talked about Sharpe ratio. We just talked about yield. The dividend yield is for stocks. The yield for bonds is the same thing, although the yield is generally paid out in semi-annual payments. Usually you get 2 payments per year for a bond, okay? And then lastly, the distribution history. So how consistently are those distributions being paid out? Okay, so that's a lot of metrics that we just went through. The reality of why did we just go through all that? Why are we talking about all these numbers? Well, again, the reason is so that we have a basis for separating the hype from the facts. Okay, so we all are victims of sources of hype through social media or influencers or the investment magazine's top 10 stocks to buy or marketing materials or bias analyst reports. So there's all sorts of angles out there. So now you have, with what we reviewed, uh, grounded, you have a source of metrics that you can go and you can pull up the information of the stock or the mutual fund or ETF, and you can do your own analysis, right? You can open up Google and pull up the stock, the stock ticker symbol, and you can do your own research, okay? And the question is, the bottom line here is, does the story match the numbers, right? Is what's getting put out in the media or the hype or the influences, is it matching what the numbers are saying? Okay. So I'm going to leave you with this 10-point evaluation checklist. Okay. So if you're evaluating an investment, and this holds for stocks that you might own versus whether or not you want to buy a house or maybe you want to buy a business, right? So for every investment, all right, you got this checklist. So understand what the investment owns. Right? What is it that the business does? What is it that it owns? All right. Look at the return, the revenue and return drivers. How does the business actually make money? Right? What is its product or service? What does it charge? How does it make money? Okay. And then review the profitability, right? This is for both stocks as well as funds, right? Profitability and or the expenses. So analyze the cash flow, right? And then how frequently these mutual funds or ETFs are turning over their funds. Okay. Look at the debt levels. Compare the valuation or compare against the benchmark tracking. Is the investment matching the benchmark or is it lagging? Assess any competitive advantages that this particular company or strategy might have, right? There's a lot of people that are investing in gold and other types of commodities right now for various reasons. And so that seems to have a lot of momentum at the current state. Will that continue? I guess we'll see. Evaluate the management or the fund manager, right? What is their track record? How long have they been around? How well have they done in previous roles or previous strategies? Use some of the metrics that we went over to evaluate the risk of the investment. Compare the PE ratio and the Sharpe ratio of that fund, not just currently, but how has that changed over time? All right. And so use that data, not emotion. Right. So hunch and gut investing can be problematic at times. So use the data to make your informed decisions. So here's an example of a hype narrative, right? The ETF is up 40% this year. It's the next big thing. Everyone on social media is buying it. Top influencers say it will double again, and it's focused on AI, so it can't lose. Anybody heard those types of statements before? But when you dig into the details, maybe you find the expense ratio as significantly higher than other similar ETFs. You've got 62% of the fund has a heavy concentration in 3 unprofitable startups. Maybe its weighted average price to sales ratio is very expensive, and a lot of the holdings have negative earnings. The standard deviation is high and the beta is high. And although it had a great performance this year, how has it done over the last 3 to 5 years, right? So bottom line is, like, hype focuses on recent returns. The data shows how the thing has done over time relative to its peers as well as just, the overall cost. How well has it done as an investment? Okay. Okay. So here's your key takeaways. Use data as your compass. Fundamentals matter across all asset types. Using a sound, repeatable process generally leads to better decisions over time, not emotion, right? The fear of, everybody's heard of FOMA, fear of missing out, right? That's what leads people to get into investments and then when they shouldn't, and then all of a sudden it goes bad and then they run for the hills. So you now have a framework to evaluate primarily any investment, but obviously if you need our assistance, I know there's a lot of information today. If you need our assistance in any of those evaluations, we are here to help. A couple of resources I will leave you with. If you want to look up individual company stocks, you can go look at the SEC's Edgar database or just go to the investor relations page on the individual company stock site. You can utilize tools for mutual fund or ETF research such as Morningstar or ETF.com, or look at the fund prospectuses or fact sheets. And do some education of yourself. So using Investopedia, Boggleheads, maybe you might want to take a class through the Khan Academy, which provides free foundational lessons on topics such as this. Okay. All right. So right at the top of the hour, I probably have a time for a few questions. If anybody has anything that they'd like me to cover more in depth or clarify for you. So does anybody have any questions? Feel free to open it up and unmute yourself. And if not, that is okay. You are welcome to reach out to me separately to ask your question in a more confidential environment. So, okay, doesn't look like we've got any questions. So with that, I will let you know what's coming up. We still are doing our monthly market update on what's happening in the markets. The next one will be Wednesday, March 11th at 11 a.m. And the next educational session is going to be on our favorite topic, what about taxes? We're going to talk about some common tax planning strategies, given the fact that tax time is here and the tax filing deadline is upon us. That is Wednesday, March 25th at 12. So look for the invitation for that. Okay. All right. With that, I know this is pretty deep, so I will let you all go get the rest of your day back and hopefully recover from the brain exercise that I put you through. So everybody have a great day. Enjoy your week, and we will talk to you next time. Take care.